Welcome to Thimbleberry U. I'm Michelle O'Dell, your host, and again, it's Amy Walls. Today's episode, S&P 500. It's not a diversified portfolio. What is an S&P 500 fund?
Yeah, well, first, let me take a step back from the, S&P 500 fund, and let's talk about the S&P 500, which is a stock market index that measures the performance of 500 large companies listed on the U.S. stock exchanges.
Okay.
It was created by Standard & Poor's. That's where the S&P part comes from, which is a leading financial services company, and it is widely considered to be one of the best indicators of the overall health of the U.S. stock market. So the S&P 500 includes companies from a diverse range of sectors, such as technology, healthcare, finance, consumer goods, but it's not diversified in terms of asset classes. And what I really mean by that is there's small cap and mid cap and large cap and international, and it's not covering all of that. It's really covering large companies. So your question, though, was what is an S&P 500? You can't invest in the index, the S&P 500 itself, right? Because it's a measurement of health. So companies have started index funds or ETFs that mimic the S&P 500, and the ease at which people can invest in those, along with performance recently, has made those index funds or ETFs really popular investments in recent years.
How does diversification reduce investment risks and increase returns compared to solely relying on the S&P 500? And then what are the risks of relying solely on one index for investment growth?
It's a big question, or a couple questions in there, right? A lot to unpack. So I'm going to do my best here.
Okay.
So basically, the thing to know is that diversification reduces risk. So let's say you have 4 investments. They're each 25% of your portfolio. And over the course of a year, one of them does well, one of them doesn't, and 2 are just kind of in between. Basically, your risk was reduced from that one dropping by the other 3, one of which did well and 2 just kind of continued as they were, right? Middle of the road. But over 5 years or over 10 years or longer, that risk is different because they're not all going to perform in the same way they did in that 1 year. That's how diversification helps. It keeps it all from going down at one time. It also essentially just isn't about not having losses, but it's reducing loss, giving a more steady climb over time because you have opportunity for growth in other areas. So it's not just about avoiding risk, it's about opportunity elsewhere. So while the S&P 500 has historically performed well, it is important to understand that it's, as I said, just one index that represents only a portion of the entire stock market. So when someone invests solely in the S&P 500, they miss out on potential opportunities for growth in other sectors and industries and asset classes. So another way you can say it is relying solely on the S&P 500 exposes clients to greater market volatility and risk because there's all these other areas that are missed. The other thing is companies are similar within the S&P 500. So if one of the companies experiences a downturn, or if all the companies experience a downturn, they're going to experience a much more significant loss by investing just in the S&P 500. I think sometimes some numbers help because I think the big thing on diversification here, I rattled off all the ways it is diversified earlier, but the asset class piece is a huge part of that. So this is from 2021, and these things shift a little bit. It's hard to say this is exactly it. But, the S&P 500 is really large companies. It can overlap a little into mid-cap, a little bit. But it was 30% growth, 21% value, and 49% blend as of August 2021. Let me give an example here. My kids are out of school. It's only been a few days. But investing solely in the S&P 500 is a little bit like having a child that you send to school with instructions that they only get to study math.
All right, that's not good.
That's not good. They need reading and language and history and science and some PE and music in order to be a well-rounded human. The same thing's true when we're building a portfolio. We want it to be well-rounded so it can weather different storms and not be basically attacked if the one area, ruined if the one area goes down heavily.
So there's always fees, okay? You can't get away from that
Absolutely.
in life. How do fees associated with investing solely in an S&P 500 fund compare to fees associated with more diversified investment strategies?
Yeah, so an S&P 500 fund, index or ETF, typically has a very low expense ratio compared to actively managed funds. So that makes it popular along with the performance that it's had. So actively managed funds, which are often part of a diversified portfolio, have higher expense ratios due to the higher costs associated with the research and management. Okay, so there's more attention given, thus costs go up. Some diversified investment strategies may include sales charges or commissions. All depends. Same could be said of S&P 500 funds. And those costs, of course, no matter where they happen, increase the overall costs with any investment. I think here, fees depend on how you're getting it, what your relationship is. Are you doing it yourself? Are you doing it with an advisor? Like all of those pieces play a role. But the trade-off really that we want to look at is just S&P 500 versus being more diversified. And I think that's the real question and where someone wants to focus before you start to get into costs.
What are some of the historical examples of times when relying solely on the S&P 500 resulted in significant losses for investors?
It's a great question, Michelle. There have been a few times. So during the dot-com bubble, which was 2000, 2002, was one time. In the late 1990s and early 2000s, there was a rapid rise in the valuation of internet-based stocks. We are both old enough to remember that, and probably many of our listeners are too. But that was the dot-com bubble. Okay, it was this increase, and many investors who were solely invested in the S&P 500, which heavily favored tech stocks, and because we work with tech stocks, we hear a lot about the S&P 500 from clients at times. They experienced significant loss when that bubble burst. Okay, then there was the global financial crisis. So that happened in 2008, caused a major recession that led to significant losses for investors in the S&P 500. So that was a second time recently. Then during the pandemic, when that first hit, we had the announcement of COVID-19 and stay-at-home orders and all of that caused a sharp drop in stock prices, and the S&P lost roughly 34% of its value from peak to trough. It did eventually recover, as most of our listeners will know, but for those that were heavily invested in it, they experienced some significant loss during that time. And then let's just look at last year, 2022, the market was down. The S&P was down 25%. So I love that you asked this question, and I think these examples illustrate the importance of diversification investment portfolios. So using our example earlier from school, if we just study math and we skip all the other classes that are important, well, for one, we haven't taken language and writing and English and, or language, whatever language we're talking. And how are we going to communicate about the math we know?
Exactly.
We're going to struggle to do that. So we need to be more well-rounded. I mean, ultimately, I am a financial planner. And as a financial planner, I believe investors do need a comprehensive investment strategy. And that's not just, hey, everybody needs this diversification in this portfolio, but it has to be a portfolio that takes into account their unique circumstances and goals.
Exactly.
It's got to be about their situation.
How can we implement more diversified investment strategy while still maintaining exposure to the S&P 500 then?
So as we just talked about, I like diversified investment strategies. That means they include a mix of asset classes and sectors. And so to implement a more diversified strategy to minimize risk while providing exposure to these different markets, someone may need bonds. Incorporating fixed income securities such as bonds into a portfolio can provide a buffer against market volatility and offer a regular stream of income. Often, I find a mix of government and corporate bonds with varying maturities makes sense, but it all depends on investor risk tolerance too. Okay. For some people, this doesn't make sense. For others, it does. Other equity classes, so equity being stock, could come in the form of different investment products such as actual stock holdings, ETFs, mutual funds, or other index funds. Our clients have a broad array of those things. Then there's alternative investments. So these are things like real estate investment trusts or commodities. These would be more like how our school system typically views PE and music. You don't get a lot of it in the course of your day. Mm-hmm. You get some. And so these alternative investments can usually, I think you want to think of them being more like sprinkled in to the portfolio rather than being a major component. And these provide additional diversification and exposure to non-correlated assets. Now, that's a term we haven't talked about. And I'm sorry, listeners, I threw a big lingo term at you. Non-correlated just basically means that it doesn't react in relation to stock movement. So if stocks and alternatives are not correlated, when stocks move, alternatives don't necessarily react. Whereas people think of stocks and bonds kind of doing opposites, but they've actually more recently become much more correlated to each other.
What steps can our listeners take to manage risk and mitigate potential losses in their investment portfolios beyond simply relying on the S&P 500?
One is the thing we've been talking about the whole time, right? Diversifying the portfolio. And I get it. For people who are doing it yourself, figuring out appropriate diversification, it's not an easy thing. It's art and science. And so I get, S&P 500, boom, I'm diversified. I understand the logic. It's just a false sense of security. So we need different asset classes, different sectors, different geographic regions, and that can minimize the impact of market volatility and reduce overall risk exposure. We also talked about alternative investments. These are, like I said, real estate and commodities and private equity. They're just a sprinkling that can go into a portfolio to help give some offset. And again, a trickier thing to do on your own. Other things are regularly rebalancing your portfolio. This is a big deal, and I think it often is overlooked, especially in a taxable account. People say, I don't want to rebalance because I don't want to incur gains for no reason. Well, regularly rebalancing resets to your desired allocation. So earlier I talked about 4 investments of 25% each. Let's say 2 of them stay at 25% of the portfolio and 1 of them goes up to 40%. So it grew by 15, which means for our math to still work out at 100%. The 4th one that dropped had to drop from 25% to being 10% of the portfolio. Rebalancing is what brings them back to 25%. That is minimizing risk, but a lot of times people will look at that and say, I don't want to buy more of the one that went down, right? Because there's a reason it didn't do well. Well, we have to look at it and say, is it the actual investment that's bad? Is it the asset class that didn't do well, right? And diversification says some asset class in your portfolio isn't going to be doing well basically at all times.
Exactly.
So as long as it's not just a bad individual stock, but it's something that's performing well in relation to its peers, equal to or better than its peers, then it's a good investment. It's just not its time. It's a bad day for it.
Right.
Bad year for it. And sometimes we get an asset class where that's going to be for a while, but bringing it back means that now you're in relation. So the next time, one of those holdings that stayed at 25% or the one that went to 40 drops, you're positioned to actually recover from that.
When you say regularly, how often?
We rebalance portfolios quarterly.
Okay.
So at least once a year is for clients in their 401ks. Once a year makes sense.
Okay.
If they have an option to easily do it more frequently. Quarterly is a great frequency. There's no reason to do it daily, to do it weekly. I think monthly, I've seen some automations on systems that will allow monthly. Could be a little much, but couple times a year to at least once a year. And then the other thing that I'd say to answer your question is to have a long-term investment horizon. Now, if you've got a short-term goal, obviously you can't have a long-term investment horizon. But if this money isn't needed for several years, then if you're thinking long-term, it's easier to avoid reacting to short-term market fluctuations. And that mentality, just helps. So if it's a short-term goal, well, then maybe it shouldn't be in the market or you need a portfolio that's really designed for that shorter time frame. And the S&P 500 is not designed for a short time frame.
Exactly. Well, I do feel a lot more knowledgeable now. Thank you very much, Amy. And I'm sure your listeners have gotten a lot out of this episode. If they have any questions and want to know more, how do they contact you and your staff?
People can get a hold of us at thimbleberryfinancial.com or by giving us a call at 503-610-6510.
Fantastic. Until next time.
Sounds good, Michelle.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer. Member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Thimbleberry Financial are not affiliated.